So, guys, today on the podcast, I've got Akash Desai. Akash is from OnPoint Mortgages, and he also is the head of insurance over there. Some of you may not know, but Akash actually started Lifestyle Property People with me, and we used to work in the business together, and that was a great time. Akash, I always tell people how much I learned from you back in those days, although probably it wasn't until later on that I realized how much I learned from you. You know, when you left, and I was like, oh my God, you've left a Akash-sized hole in my business and in my life. But no, great times and really great to have you on this podcast. So yeah, welcome to you.
Thanks for having me, Shiv. Really looking forward to being here. And yeah, like you, looking back with amazing fond memories.
Fantastic. So today on the podcast, what we're going to do is talk about insurance, and specifically life insurance. And the reason I want to talk about life insurance is because it's a little known part of investing in property. When people think about investing in property, obviously they think about the property, they think about, refurbishment works, they think about tenants, but what they don't think about is the other side of it. So Akash, let's start off with the first question, which is how important is life insurance when it comes to investing in buy-to-let? Why is it important?
So life insurance is important when you've got a mortgage. So anything where you've got a debt is where you should really have life insurance. So if you've got residential property, let's start off, you have to have somewhere to live, even if you're buying buy-to-lets, you'll have a mortgage normally. So if you have a mortgage, one of the reasons life insurance was originally invented was to cover debt in life. So for your own residential property, what you want life insurance to cover the debt. So if you passed away, your partner, if you've got one, children, if you've got them, can stay in the house. Because if you don't, there is a possibility that the lender can call back the loan and your family ends up with no place to live. But in same with buy-to-let. So buy-to-let properties, most people buy for an investment, and you can pay off the balance of your buy-to-let properties upon death and pass on an unencumbered portfolio. So you're passing on a cash flowing unencumbered portfolio to your beneficiaries.
And I suppose the reason why that's important is because this is not always the case, but in most cases, we have one person, let's say you're in a couple, there's usually one person that's kind of understands how to build the portfolio, manage the portfolio and sort it all out. And then maybe there's another person in that relationship who kind of doesn't usually understand the ins and outs of all of those things. Or even if you're in a partnership like my wife and I are, she looks after some elements of the business and I look after some elements of the business, but we don't both look after everything. That makes no sense. So as a result of that, what you're saying is with life insurance, because it enables you to pay off the debt of mortgages, it means that the people that you leave behind, your family, your partner, etc., are not left with wondering, what do I do with this, asset, with this debt, with this liability that I have now? It all gets paid off. There's nothing to worry about, and ultimately, it gives them the peace of mind that it's all been sorted.
Exactly. I mean, I've got some stories that I've seen, but this is exactly it. In a relationship, let's take that one step further, and you've got one person, whether it's the man or whether it's the woman, who deals with the finances, right? They pay the bills, they make sure the bank statements are correct. Now, when that person leaves, if the other person hasn't been dealing with it, not only are they worried about money, they don't even know where everything is, how everything is done, and having that money paid upon death really is a real lifesaver at those times.
Yeah, fantastic. And actually, there's somebody that we both know. I won't mention any names on the podcast, but they built a portfolio of properties, and the reason for them building the portfolio of properties was so that they built it for their family. They built it so that they could make sure that their wife and their kid and everyone could live comfortably into the future. And then, unfortunately, what happened is they ended up getting cancer, and when they unfortunately got cancer and they eventually passed, they just left a big problem behind, because there was all these properties in all these different locations, different managing agents for each one, etc. Then you had the mortgages, who's paying what, when are they coming up for renewal, all of that stuff. And they actually had 3 kids. So the man passed away in this instance. The woman was left behind. She's left behind with looking after 3 kids. The last thing that she wants to do is worrying about properties that she doesn't know where they are and she's never heard of, and how to sort out the mortgages on them.
Exactly. The whole reason property investors build this up is to provide, and I'll talk about this, is a concept of generational wealth.
Yeah.
But if you don't do it right, you're just going to leave this generational mess, which is, and it's completely the opposite of what you're trying to do. But it needs people to take the time to build this plan out and think it through properly.
Fantastic. Thanks so much. So what types of life insurance are available to property investors, and what are the key differences between them? Because we know that it's a minefield when you try to look at it yourself.
Yeah, so I'll talk about types, level, and kinds. So there's two main types of life insurance. The first is called term assurance. So term assurance pays out on a policy for a defined period of time. So it could be 5 years, 10 years, 25 years. And the aim of term assurance originally was to coincide with a mortgage. So if you had a mortgage which was 25 years, what you're trying to do is you're trying to cover the possibility of you dying through any part of that 25 years. So you have a life insurance policy that runs also 25 years. So for a residential property, you'd get a decreasing term mortgage, which runs alongside it.
Because you're saying, for example, on a residential, you usually have a repayment mortgage. So the amount that you'd owe would decrease. That's why you'd get a decreasing rate mortgage, or whatever you say.
Exactly, yeah. So the difference between a residential and a buy-to-let, residential, you're paying the capital and the interest, whereas in a buy-to-let, you're just paying the interest. So the capital will be there at the end. So as you pay the capital down, your actual mortgage amount reduces over the years. So you'd be paying a lot less in year 20. Now, one way they make term assurance affordable is to keep that in line with the mortgage. So in year one, if your mortgage was 100,000, it would pay 100,000. But then in year 25, it would only pay, say, £5,000 because that's how much is left of your mortgage. So that's decreasing term. And the definition of term assurance is if you die within that period. I guess the one point to mention on term assurance is if you don't die within that period and you live to 26, it goes to 26 years and you die, then nothing is paid out.
Right. Okay.
So it was there. It did what it said on the tin, but it won't pay out. There's another type of policy called whole of life. And whole of life is when insurance as opposed to if insurance. And the whole of life is used to pass on something to your beneficiaries rather than cover a mortgage, for example.
Okay.
Because what happens with whole of life is it will pay out. Whether you die at age 50, whether you die at age 100, it will pay out a lump sum. So there's two main types: term assurance, which is normally linked to a mortgage and a prolonged period of time, a defined period of time, and a whole of life, which is it will pay out when you want. And it's used for, like I said, covering inheritance tax or passing on money to your beneficiaries. Then there's three types of level. The first, we've talked about decreasing, which is it goes down along with your mortgage. You've also got level term, which is if you've got £100,000 interest-only mortgage on a 25-year term, you'll be paying £100,000 back, whether it's in year 1 or year 25. So what level term does is it keeps that £100,000 the same, whereas in decreasing, that would go down. And then the final type of level is increasing. So we all know about inflation eroding our money. So if you're looking for a policy to cover a payment to your beneficiaries, then increasing indexes your cover. So your 100,000 in year 2 could be 101,000, depending on what the percentage is. Year 5 could be 105, but then that's increasing. So there's three types of levels.
3 levels, yeah.
And then there's also different kinds of mortgage, let's say. So the first one is life assurance, which is what we've just talked about, which is the aim is to pay off the mortgage and keep the family in their home.
Okay.
The second one, let's call it a solution, is critical illness. So life assurance over the years has become a lot more affordable. And the reason for that is mortality rates are increasing. So we've got much more advanced technology, our life expectancy is increasing. Now, because of that, in terms of risk, it's quite affordable because the chances of you dying are a lot less. Critical illness, on the other hand, which relates to morbidity rather than mortality. Morbidity refers to the rate or frequency at which illnesses or diseases in a population over a specified period of time happen. So an example would be, nowadays we hear statistics from some of the insurance like Vitality, which is 1 in 2 people have cancer.
Yeah.
But what critical illness does is it provides a lump sum on diagnosis of a critical illness. That could be, for example, heart disease, stroke, cancer, or whatever's defined by that insurer.
Yeah.
And the aim of that is you get a lump sum, 50,000, 100,000, 200,000, to either pay off your mortgage or just help you get over that problem and recover. Yeah. The last thing you want to do when you've had a heart attack or a stroke is I need to go back to work to earn money to pay the bills off. So critical illness is one of those. And for me, that's probably more closer to home because my father actually had a stroke, heart attack, stroke.
Right.
And yeah, so he wasn't in the best of health and he didn't have critical illness and he didn't have life assurance.
And
So
saying about he wasn't in the best of health, but in these days, I mean, I've seen people that are in great health and they still have heart attacks. You know, so it's I don't think
yeah,
it's. I mean, I thought to myself, I thought, well, I'm quite sporty, I do a lot of running and whatnot, and so I'm in good health. But that doesn't preclude me from having a heart attack. It doesn't preclude me from having a stroke because these are the things that you know, you can't see. They're inside your arteries and stuff. So I think when you talk about critical illness, the point I'm trying to make is that I thought it was only for people that are like old and sick or likely to get sick, but actually I realized that it probably applies equally to everybody who at least has, for example, a partner, a family, or doesn't have a huge amount of savings or wants to think to themselves, well, actually, if I do have a heart attack, I don't want to be in a situation where I have to go back to work just because I need to go and earn money.
absolutely. You know what? And it's a really good point, Shiv, because when I was thinking of getting into protection, because I'm very into my health and fitness, one of the reasons I got into protection is healthy people need protection too. You know, it's exactly like you said, there's people who are higher chance of getting ill, in example, critical illness. Um, but for example, let's take health insurance, which is the next one. Health insurance is one that is quite important for property investors or people in general. When you've got the NHS waiting list over 7 million, like, and we've seen what's happened post COVID, getting access to healthcare professionals quickly when you need them is really important because as a property investor, your family depends on you, and you need to look after yourself as your number one asset. And I've seen a lot of people who you know who don't look after them get sick. And again, people in the fitness world, like you know, for me and you, is you get injured a lot as well. So
Yeah.
you know, getting access to a physio to get healthy again is really important. So health insurance is the third one, but also really ties nicely into your point of healthy people need protection too.
Yeah. So those three, just to recap, what you're saying is there's one that's called life insurance, and then the other one is called critical illness, and the third one is called
Health
health
insurance.
insurance. So life insurance is if something happens to me in my life and I pass away, whether I pass away at a particular time or whether I pass away at some other time, the life insurance, depending on the policy that I have, will pay out. Critical illness is if I haven't passed away, but something's happened to me. I'm critically ill. I am, like you said, stroke, heart attack, cancer, those kind of things. That will pay out a lump sum usually in those instances to help me get over that difficult time in my life. And then health insurance is kind of like I haven't passed away, I'm not critically ill, but it's the ongoing insurance that I'm paying to say, well, if something happens to me, at least I know that I'm kind of covered for it's like, as you said, for for I suppose annual medical expenditure for everyday things that happen to me. Is that right? What's health insurance for?
Yeah, so exactly. So the first one is for it is mainly for your loved ones, right? Life insurance helps your loved ones.
Right. Yeah.
Where the beneficiaries, where for critical illness and health insurance, the benefactor is yourself. So health
Yeah.
insurance is when you get ill for any reason, like you've thrown your back out, you've got a really bad cough, anything that affects you day to day outside of a critical illness or even a critical illness, you can go to a GP online. So
Yeah.
imagine it. Remember back in the day when I was a child, I had to wait 5 days to go to a GP.
Yeah.
With health insurance now, like I booked one the other day and I had a call 3 hours later. I said I'd thrown my back out. I spoke to a physio straight away. He gave me rehab exercises there and then.
Yeah.
I did that 4 days and I continued doing it. You don't
Yeah.
stop. And I started seeing an improvement, but the time difference on that health issue was massive compared to what it could have been, which was, it could have taken a few days to see a GP. And
Yeah.
then again, weeks, depending on what the situation is, I'm just guessing to see a physio. So it's time of review. Let's just call it that, which is as soon as you've got
Yeah.
an illness, you get to speak to someone straight away. But so that's on the GP side. But again, if you need to see a specialist, those waiting lists can be months.
Yeah.
Whereas with
Yeah.
private medical, that can be brought down to 2 weeks, depending on what it is.
And I was talking to an accountant just a couple of days ago, and we were talking about the kind of things that we can put in, we talk about buying a property. Most of our clients will buy a property in a limited company. And as a result of buying a limited property in a limited company, there's a couple of benefits. One of those benefits is the fact that, for example, you can put some life insurances through the company. Can you talk a bit more about that?
Yeah, yes. Yeah, no, that's fine. So in terms of
So you're
health
saying it's
insurance,
like in the company you can do relevant life, and actually your company can pay for it, whereas in health insurance you've got to pay some taxes or something if you do it through your
yeah,
company.
so I'll speak about both. So uh, health insurance, you can pay for your business as long as it's a trading business. It does attract benefit in kind tax,
Yeah.
but you can still pay it through the business. So in terms of tax effective solutions, um, property owners, stroke business owners who are on PAYE have more tools to their disposal than people who are working for themselves.
Okay.
So again, like I said, you can, as long as you've got a trading business, you can pay for the insurance for your company and get tax relief on the insurance premiums. The
Yeah.
policy you spoke about was a relevant life policy,
Yeah.
which is what an employer stroke company can take out on the life of its employees.
Yeah,
Um,
I got you. Okay. So
so
you've
the
got to obviously own the company in order to be able to do that. Yeah.
Yeah, yeah. I mean, but you could take it on key members of staff as well.
Yeah.
But one thing to highlight on that is some insurers have a maximum amount of cover based on multiples of income, which is subject to HMRC limits. You know, there's some disclaimers we've got to do in
Disclaimers, yeah, of course. And
yeah,
and to the listeners to this, I said, is that all right? It's because obviously Akash has actually had to prepare for this this call that we're having, this podcast that we're having, because at the end of the day, all of the things that he says are seen as what, Akash, like advice, basically. And obviously you've got your FCA regulated or whatever, you've got to be
yeah.
careful about what you're saying.
So
Cool. So
none of this is constituted as advice.
yeah,
So I've got some more points on relevant life.
yeah,
So
go for it.
in personal name, you're paying post tax. You know, you've paid your corporation tax, you paid
Yeah,
your income tax, and then you're paying life insurance. If you're paying it through relevant life, which is tax deductible as a business expense, and the proceeds to death are also tax free. And under relevant life, premiums are not treated as benefit in kind, and the lump sums that are paid are a relief from income tax. Um, yeah,
but are they? If you say the lump sums are paid are free from income tax, does that mean that the lump sum is paid to you? Surely is the lump sum paid to the company? Because
No, so the main thing about a relevant life policy is it's set up in trust. So a trust
okay.
is a wrapper that sits outside your estate. So what
But
happens is,
sorry, Akash, just to make
yeah,
it not so complicated, what we're saying is
yeah,
the trust allows it to be paid by the company, but when if something happens to you, to be paid directly to the beneficiaries rather than to be paid into the company.
exactly. Yeah, company pays
Right.
into trust, trust pays to the beneficiaries.
Fabulous. Okay, perfect. Akash, I know we've spoken about some of this stuff before, but what are the common misconceptions that property investors have around life insurance? Because you must hear this all the time. You know, you're someone that helps property investors to understand the benefits of it. What are the common misconceptions that you hear from time to time?
Yeah, that's a good question. Let me try and think because I have a great conversations with clients. Um, there's a few, so let's work through them. I think the first one that when I speak to property investors is they feel like their property is their be all end all in their life, and that's their one thing. So you know they don't need a pension. I've got property. They don't need protection. I've got property, and it's almost
Yeah,
like this bulletproof shield, which I don't think is um, always the best way to think about it. So if we delve into that, is you know some of them think you know I've got this property, and almost when I'm gone, I'm gone.
yeah,
And I think the problem with that is um, property investors have such great, let's call it a tax strategy, right? Which is
yeah,
I can make money, but they don't always have the best defensive strategies, which is passing on the assets to their next of kin in the most tax efficient ways. So the majority of landlords invest in property for income, right?
yeah.
Either to supplement or replace a day-to-day job. And quite naturally, the family of an investor becomes used to a certain level of income and lifestyle.
Of course, yeah,
So life insurance offers security for those landlords that want to maintain the family's standard of living in the event of their own death. So it's
yeah,
not for the investors' benefit, that one
yeah.
specifically. Critical illness and health insurance is, but it's for the investors' loved ones.
Of course, yeah,
So in addition, their portfolio investment may not always go the way it want, right? It could go up and it could go down, same as
Of
any other.
course.
Yeah. You know, you may have to sell properties just as any other investments. So having something called a financial resiliency plan. Financial resiliency is defined as your ability to withstand a sudden dip in income or an increase in expenditure, is having a plan which hopes for the best but plans for the worst is what you want. So the point I'm making here is the property is great, but have a defensive strategy. Don't just think it's just about property. Do think
Yeah.
about life insurance.
Yeah, yeah, absolutely. Because like you said, things could happen and things could go wrong. At the end of the day, we need to have a plan B. That's what this is.
Exactly, exactly. And then I think that takes me to my second point, which is that point of firstly thinking my property is everything, but the second one is just not planning for the future.
Yeah.
And you know, you've worked too damn hard to amass a portfolio to then get taxed another 40% on, when really you could create at this point generational wealth.
And the 40% there that you're talking about is inheritance tax, obviously.
Exactly.
Yeah.
So you've been taxed multiple times, but if you haven't done it in the correct structure, and it goes over the nil rate band, which I'll talk about, is you could get taxed another 40%. So
well, take us into that, because obviously now what we really want to know is like, how can we make it tax efficient? How can we take advantage of the tax things that are out there for us to not have to pay additional tax?
Absolutely. So I'll come on to that because there's 3 levels of debt that I advise my clients on based on their situation. The first is cover your residential property, make sure there's a roof over your family's head. The second is cover your portfolio so you can pass this on. So most people have a portfolio which is on interest only. So you can get level term insurance, which doesn't decrease over time, like residential. And this means you're passing on an unencumbered portfolio, which is income for generations to come. So this is almost like the golden goose, right? It's generational wealth.
Yeah.
And the third one is what you want to get into, which is covering your inheritance tax liability. So the whole portfolio is passed on. Because if you don't, then we'll talk about what happens. So the problem is if we've got a couple, say they've got a property's worth 2 million with a debt of £500,000, that means they've got equity of 1.5 million.
Yeah.
And in this example, let's just make it simple. The residential home is paid off. So on death, what happens is, firstly, the beneficiaries don't get the properties upon death of both parents without a trust or having to go through probate, which is essentially where the HMRC come for the inheritance tax. So in this situation, if we've got a nil rate band, so inheritance tax has a nil rate band of £325,000 for your assets and £175,000 on your residential property.
Yeah.
So one person has £500,000 or a couple has 1 million.
Yeah.
So anything above 1 million is charged at 40% in personal name.
Yeah.
So if on death, someone has more than 1 million and let's say there's hypothetical inheritance tax liability, unless the beneficiaries have liquid the amount they need to pay the inheritance tax off,
which is going to be a significant amount because it's 40%.
Exactly. Then they
and sorry, just realised, the penny just dropped for me. It's 40% of the value of the asset, or the value. It's not 40% of the income or anything like that. It's 40% of the value of the asset.
Exactly, and they call inheritance tax a stealth tax because, you know, if you look at property prices and how much they've increased over the years, and I believe last year was 10%. You know, this hasn't changed for many years. So by the fact that it's that this nil rate bound of 325 plus 175 staying the same while property prices are going up is automatically disadvantageous to us. So in this situation where the beneficiary doesn't have the inheritance tax liability, they've got a few options, right? Firstly, they need to go to HMRC and say, please, can we have an extension, which they don't have to do, and they can actually charge you interest. And then you can say, can we sell these properties? But then again, you're time bound, which is disadvantageous. So you could have to do some of the following, right? If you've got a portfolio, you might have to sell a property with great yields, which is a loss of income for the deceased's family.
Of course.
If the economy is down, the family may have to sell a property at a loss.
Yeah.
Now, I know investors buying probate properties. Now, in this situation, you actually end up on the other side, right? You're the one who's a motivated seller.
Yeah.
So no one wants to be there. Properties being in negative equity, having to be sold, and again, that has to be paid out of deceased estate. And then if you've got mortgages held by the deceased which were on base rate trackers. And, some people had
Yeah.
these great rates. So even if the family could buy that property with a mortgage, the net income is hugely reduced when these mortgages are replaced by standard mortgages.
Yeah.
So if you haven't got a plan in place to cover inheritance tax or understand your assets and liabilities, it's going to leave that mess. It's not going to be that generational wealth that we're talking about.
And so how do we solve that? What's the plan to solve that?
So one of the ways, not the only way by any means, that we've used is use a policy called whole of life. So if we know a liability is going to be £200,000, for example, we create a whole of life policy in trust, which means upon death, the insurer pays out the £200,000 to the trust pays the beneficiaries, they pay off the inheritance tax, and then the portfolio and the assets are given to their beneficiaries and intended, and we achieve generational wealth.
So basically what you're saying is that if, like most of our clients, will have assets more than £1 million because their residential home is included in those. As a result of that, anything in their personal names, they'll have to pay inheritance tax on. If they don't have the funds available, or if their descendants don't have the funds available, then HMRC could, force a sale basically and make them do silly things like selling properties at below the value that it currently achieves, or making it sell it quickly, which means that again it's going to be below what the value is, making, like you said, selling a property that's already high yielding and getting rid of assets that which would ultimately impact income. And the way to solve that is to basically get an insurance product which is through whole of life insurance, and that whole of life insurance will pay out on death, and that will be effectively to cover the inheritance tax liability, which means that one of the ways to solve this is to say, let's take out this insurance product, which is probably going to be, depending on the portfolio, 100 quid a month or whatever, not a huge amount, but ultimately it will go into making sure that the family can then get the properties and not have the tax liability, get rid of the tax liability, or pay off the tax liability, I should say.
Yeah, essentially. But a few caveats is each person should go see their financial advisor just to understand their circumstances, because it is different. In terms of the HMRC, they don't force you to sell, but if you want the portfolio, you have to find the money. So effectively, roundabout is the same thing. And finally, whole of life is one way to achieve covering this. But if you look at the other way is you've got a £200,000 liability that you need to find. And most people, again, if they were dependents on you, they're not going to have that liquid. So
of course, fantastic. And then just rounding this off, so what are the key factors that property investors should consider when choosing life insurance policy? Because there's loads of people that sell this kind of stuff. We don't know anything about it, frankly. What are the things that we need to consider when we're looking for life insurance policies or products?
Sure. So I think the first is to determine how much coverage they need and what type of coverage would be most appropriate. So this can depend on factors such as their age, their health, financial obligations, and the value of their property investments. So this is why it's always important to speak to a professional, understand your assets and liabilities, and build up that picture of where they are now. So, but just 2 points on that. That's where they are now. And a good broker should also review the client's needs on a yearly basis, because if you're single, your needs are going to be like, look after yourself as the income earner. You then get married, you then have a child, you've now got dependents. Again, that's a change in circumstance. You buy a house, change in circumstances. So just to add to what your question is, when you speak to someone now, but you should always review insurance policies as well. So
that's a really good point as well, because I think so like myself, most of our clients and most property investors are looking to not just buy one property, they're looking to build a portfolio over time. And so what you're saying is my portfolio might be X right now, and I can go and get life insurance for that. But actually what I need to do is review it annually, because if I'm increasing my portfolio annually, I need to make sure my life insurance policy covers those mortgages. Otherwise I could still be left with a shortfall.
Exactly. And you can either forecast the debt moving forwards, or you can review. And some insurance policies allow you to increase your sum assured. So if you've got 1 million, let's say 1 million, and you want to increase it to 1.2, we can just go back to the same insurer and say we want to increase it to 1.2. But like you said, it's getting the right one up front, but also making sure you've reviewed it and got the right coverage moving forward.
And would the broker not do that? So let's say, for example, we're working with you, because you guys do obviously you're brokering life insurance as well. Will you on anniversary, so let's say every year, message me, email me, call me and say, by the way, it's been a year. Is that something that's their responsibility, or is it something that's actually my responsibility? I need to make sure that I'm calling them.
No, I think it's a bit of both, but we do that. So we would
Okay.
call up and we would just say, Shiv, how you doing? Like, how's it going? You know, and it's really important to understand where people are in their life. And it would just be like, how's it going? You know, I've done that with clients and they're like, oh, I'm expecting a baby. And it's like such great news, right?
Yeah.
But then it's like, okay, you're expecting a baby. How does that change your situation? What do you need to think about? And that's when we can have that conversation. But yeah, we follow up with our clients on a yearly basis to see how they're doing.
Yeah, perfect. And can you share any real life examples then of factors that that people should choose when they're looking to invest in life insurance?
Yeah, so I mean, I've had some good real life examples, and I've got some bad real life examples. So I'll start with
Give us the bad ones, Akash. We always want the bad ones.
Yeah, okay. So I'll go bad, good then.
Yeah.
So, gentleman living in London, he had a 1.5 million pound house. So it's a nice house, right? He's got a good standard of living. He's got a property portfolio, and he'd been meaning to sort out his insurance for a while. The two kids, who are now men, were financially dependent on him for the income and everything else. And he'd been meaning to sort his life insurance out, but he hadn't. Upon death, the house was sold off and a good amount of the properties were sold off to pay off the debts and the inheritance tax. And the two boys actually now live in a two-bedroom flat. Now, they're not on the street, but the important thing to take away is he worked hard all his life to build up a standard of living. That lapse of planning has, again, decimated this concept of generational wealth. And they're living in a two-bedroom flat. Like, you know, for them, it's a stark contrast.
Yeah, right? start all over again, it sounds like, isn't it?
Yeah. So that's one in terms of what didn't go well. Another one was quite a sad one. Is, you know, the thing about life insurance is people like to think it's not going to happen to them, right?
Yeah.
Even me, like, you know, I like to think I'm healthy, but you know, I've thrown my back out, and you know, my dad was he had heart attack, stroke, like I said, and I did a recent test and it said I'm predisposed to heart disease, right?
Sure. Yeah.
So, you know, even though I think I'm not, it can still happen. Now, I heard a story from one of my colleagues, is we had a couple purchasing a property. They were even in talks about getting the cover sorted out. So this is a residential property. The gentleman passed away on completion day. So
oh my God.
It was a heartbreaking problem.
And of course, at that time, you're not thinking about, oh, I should get insurance. At that time, you're thinking, bloody hell, this guy's just died.
Yeah, exactly. I mean, what we do here at OnPoint, I was about to say here at Lifestyle, what we do here at OnPoint is we actually put life insurance policies live at exchange, because at exchange, you're legally obliged to sell. So not only has this lady lost her husband, she's lost this property, and now she's in legals about she's contractually obliged to buy the property. You know, so you know, that was a tragic story. So that's the one where give
us the good one. Go on, Akash. Give us the good one.
So the good one is this lady who was proactive, right? So she's in her 60s. She's got a portfolio of 1.5 million, cash flowing at about £120,000 per year net.
Nice.
And we were helping with one of her mortgages. We started talking and we said, look, do you have proper protection in place? We worked through it and we understood that she had an inheritance tax liability. So our recommendation to her was put a whole of life policy in place for that, which she's done now. So again, a lot of this stuff, you won't see the tangible effects.
Yeah.
And you won't be around, but you know, the impact of this is her beneficiaries are going to inherit this 1.5 million pound portfolio. Upon death, the whole of life trust will pay out to them. They'll pay off the inheritance tax liability, and they will inherit this property. They'll inherit this portfolio and an income of £120,000 per year.
Yeah.
And you know, she's got this peace of mind. You know, the beneficiaries have got this peace of mind. And often the thing about life insurance is you don't see the problems until it's too late.
Well, I think that's a really good point because I'll tell you something, right? I'm just talking about me here. Um, Obviously, I've been approached by life insurance brokers in the past. Not always, not all the time, but just 2 or 3 times in my life. And I've always thought, well, it's not for me, So I don't need to worry about this right now. I'm young, all the same stuff that I'm sure everybody else who's listened to this has said to themselves. A question I want to ask you is not on our list of approved questions, Akash, but it's like when do people need to start thinking about this? Like, so imagine one of our clients right now is buying a buy-to-let property from us. They obviously already own their own home, usually in a nice place. Maybe it's worth 500,000-700,000 pounds, something like that. And then they're now buying a buy-to-let property that's worth 150 grand. At what point should they get in touch? Should they reach out? Because I guess the answer to this is that unless they reach out, nobody's going to get in touch with them. Does that make sense? Like, for example, when you buy a property, you've got to get insurance, buildings insurance, but you cannot complete if you're buying with a mortgage. You can't complete without buildings insurance. So the buildings insurance is almost like baked into completion. It's going to happen.
Yeah.
Whereas with life insurance, what you're saying is no one's going to do it for you. You've got to get up and do it yourself. Is that right?
Exactly. And it's so, I don't want to say the word ironic, but we get pet insurance, we get house insurance,
Yeah, mobile phone insurance.
Mobile phone insurance that we pay this money for, but we are the most important asset, and that's not necessarily mandatory. But to answer your question is, most brokers and ourselves included, is we have the protection conversation upfront. If you come to us and say we need to get a mortgage on this property, we will say, great, we'll look into this, and we'll also discuss the protection. And we're actually FCA mandated to have a conversation around protection, which is a good thing because, often a mortgage, either buy-to-let or residential, is your biggest financial liability. And having a conversation about what would you do if you couldn't pay it and how it would affect your life is really important. So we do it straight away in almost the first or second conversation. We give a protection recommendation alongside the mortgage recommendation. But in terms of outside of that, like life insurance, we've got this young couple who are like 22 and they work and they're about to buy their first property. And, they started looking at income protection because it's more relevant to them. And the earlier you get life insurance, and critical illness, the cheaper it is. So if you've got people who are in their 60s, 70s, critical illness is going to cost hundreds and hundreds of pounds, right?
Right. Yeah.
If you get that in your 20s and 30s for a 25-year period, it will be a lot more affordable because you're deemed at lower risk, right? Because most of the critical illnesses happen over in later life. So I think the earlier you get it, and I'll be saying this to my kids, is the earlier you get it, the better it is.
And I think that's sensible because our clients are always thinking about building mainly our clients are thinking about building a portfolio for their children, like generational wealth, etc. It's like, well, if we're building a portfolio for our children and trying to give them income, why not also building the protection into it as well to make sure that they have the plan B, whether they pay for it or whether I initially pay for it. If I have kids, I'll pay for it initially because I need to show them the importance of it. I think these are one of the lessons that I think for most people, Akash, these are the kind of lessons that we learn the hard way. When somebody else passes away and they don't have life insurance and we're like, oh my God, you know what? Actually, I need to now do it. So thank you so much, Nick, Akash. It's been a really great conversation. I think it's been really useful for people to understand. Just to recap, what you're basically saying is there's life insurance or life assurance, I think you're calling it. Then we have income protection, and then we have health insurance. Is that right? The three things?
Yeah, and critical illness. So income protection.
Income protection is critical. No, it's not critical
illness. No, yeah, so you've got life insurance, like you said, which is term assurance or whole of life. You've got critical illness, which pays out a lump sum on diagnosis.
Yes, of course.
Health insurance, which it helps you stay healthy and gets you advice if you fall ill. Income protection provides a certain level of income. I haven't included it as much for property investors.
Sure.
But for people who are on earned income, if you're no longer able to work, what does that mean to your level of living? And that's why income protection is there. And my closing sentiment is something we know in our group is plan for the worst, hope for the best, have a good financial resiliency plan.
Brilliant. Thanks so much, Akash. That's been fantastic. Really appreciate it. Where can people find you if they want to find out more about this? Because like we said, nobody knows about this stuff. They need to find out more about it. How can they get in touch with you?
So our website is www.onpointmortgages.com. My email address is akash@onpointmortgages.com. And I'm always happy to have a conversation.
Perfect. And we'll put the links to your social media pages and whatnot in our comments as well, so that you can, the listeners to this podcast can find them there. But always fantastic to talk to you, and look forward to speaking soon.
Thank you very much.
Thanks, Akash. Bye-bye.
Bye.